When you go out with your friends, would you rather pick frozen pizza or filet mignon? What does it have to do with financial planning, you may wonder? Well, what you do or do not do starting today will determine if you can eventually choose based on your culinary taste or the balance of your retirement portfolio. Watch this brief video and learn about some helpful options you now have.
Hi, I'm Sachi Carvunas, and I work with a Maryland-based company that helps you set up what are called true self-directed IRAs, where you can buy real estate, precious metals, and do private lending to individuals and operating businesses. And I'm here today with Paolo Caruso, who's an investor, and we're going to talk about how you can increase your returns in this hard economy. How are you doing, Paolo?
Just fine. How are you?
Pretty good, pretty good.
Great to be here.
So tell me more about, a little bit about what you do and why this is important during this type of an economy.
Well, as you mentioned, the economy is not at its best, to say the least, these days. So it is important to all of us to optimize our retirement portfolio so that we have better results at the end when we need that money.
Right. Now, one of the things that I've noticed when I'm looking at checking, savings, CDs, even treasury bills, you're really not even keeping up with the cost of living because the returns are so low. So, and even with retirement plans, what's happened in the stock market, back in August 5th, it dropped 6.5%, and it's related to things happening in Europe, in Greece and Italy. So, what can we do?
Well, very few people like very stiff theoretical finance discussion. So let me ask you a question. If you wanted to go out with your friends for dinner, would you rather go and have frozen pizza from the grocery store, or would you go to a three-course meal at a gourmet restaurant? Another question, in your retirement years, would you like to spend them in an ugly building, or would you like to have your own home with a nice pretty garden? Now, whether you are at one end or the other is directly a function of what your retirement portfolio is doing. And the point that I want to make here is that even small changes in the returns that you have over the years lead to enormous differences in the end result. To make an example, if we started with an account, with a $100,000 account, and let's say it grows 1% for 30 years. At the end of 30 years, that account would be at $135,000 more or less. Which
That's
is
pretty
good.
low, though.
Yeah, I mean, it has grown some, but the same account, the same $100,000 account, at 7% would be at over $750,000 balance. And if it grew at 10%, the end result would be $1,750,000 more or less.
Wow, I'd rather have that.
It's an enormous difference. And this is not inflated stuff. This is real. This is very basic math given from the compounding of interest over time. Now, the key question is, the million-dollar question is, how do we achieve results that are good enough to have these returns on a consistent basis for a long enough period to achieve those results? And the answer has traditionally been the asset allocation and diversification, which and that is where you allocate different portions of your portfolio to different investment vehicles so that the spikes high in one area balance some losses in other areas. Usually what you do is to put the bulk of your investment in what are called conservative investments, because you want to have the least volatility possible, not to avoid surprises in the future. Now, the problem is, I mean, the application of this theory has some problems. Why? Because of what you were saying earlier, that there is an enormous volatilities in the market. A few years ago, the Dow Jones, which are the strongest stock available, dropped about 50% in a matter of a couple months.
That happened to me in 2001. I lost half of my IRA, 50%.
Yeah, just imagine if you had to retire those days and start withdrawing from the account at that time. But unfortunately, even more conservative choices like bonds are very volatile at this time. You know, they have similar fluctuations. You know, the average returns these days is around 1.5% tops, and that has to be confronted with the inflation, which is much higher. So if you are stuck with those accounts, with those options, then you have to really tighten up the belt even more because you are actually losing money as opposed to gaining money.
I also noticed that CDs, when I look every month because I speak on this topic a lot, and I noticed that you have to put it in there for 30 years to even get in a CD to even get what's considered kind of decent rate, and that's still only around 3%. But you can't touch it for 30 years.
Right.
So yeah, I work with a lot of people who like to do private lending. So what kind of things can you do?
Yeah, the alternative to these dire situations that we've been describing so far is that fortunately the economy of today is giving us new opportunities to have investments that are higher returns and low volatility, which is beautiful. And this is private lending. For those who are not too familiar with private lending, private lending is where an investor, an individual investor, puts a portion of their money to fund some businesses. In our particular instance, this would be real estate businesses. And I already hear the objections, oh, but you're crazy, real estate is going down like there's no way back these days. But the thing is that we're talking about adding value to existing properties. We're not talking about investing in the long term. We're not talking about acquisition of properties and to hold them over time, which is where you expect the overall economy to improve and thereby lifting prices across the board. And this is what brought the speculation in this area, generated all the problems that we are seeing now. So we are talking about short-term projects where a local investor, a local business acquire properties that are usually in the needs for some renovation, brings them to standards that are higher than average, and resell those properties at retail value with very nice profits. And this is done consistently. This is done on a broad scale. And this is what, by the way, is improving the situations and the overall values of entire neighborhoods, which is a great thing.
Yeah.
I mean, your investment not only is making you money, but it's also improving the situation on a larger scale.
So you actually can get back to a community because you know, some of the communities have gotten to the point where, you know, crime might have come in, or you know, the values have dropped, and when you can renovate and bring up the values, I mean, the city benefits because the taxes are higher, you know, and they need the taxes to pay for fire and police and all the services that they have, and so a whole community can be improved thanks to an investor in their business and working in real estate.
Absolutely.
Yeah. How do you implement their business?
Well, these are very formal real estate transactions in a way. Many characters at play. There are real estate agents, there are appraisers to assess exactly the value of the property. There are contractors that do the actual improvement works. There are title companies, and there are attorneys, real estate attorneys that finally close the deal. So in summary, these are short-term investments on real estate projects that last a few months, and given the relative brevity of these projects, the overall changes in the market values are really not significant, don't affect that much or at all the results of the specific project, so, which is an added feature. There is obviously a lot more that needs to be discussed to show all the details and how we really implement these projects. I am sure that in your webpage somewhere there is a link that brings to more detailed information. And we are always ready to meet everybody on an individual basis. Thank you very much again.
Well, thank you for talking to me today.
Thank you for being here.